Hello everyone, my name is Vaibhav Puranik and I'm going to give you a simple tool for evaluating real estate or any other investment today. And it's really simple. All you have to do is just to do one simple math and you quickly have an answer. Okay, so let's see what that tool is. It's known as rule of 72. Okay, rule of 72. And what it does is it allows you to judge how much time it'll take to double your money. How much time it'll take to double your money. And time is important. Remember, smart investors also look at time. Time is not the only factor, but time is also very important. And that's why we have IRR, correct? But so it's you want to know, like, if at that interest rate or at whatever rate of return, how much time will it take to double your money? So let's take an example. Okay, let's say you're investing somewhere and they're saying you'll get 6% interest. So all you have to do is take 72 and divide by that interest rate, 6%. 72 divided by 6 comes out to be 12. 72 divided by 6 comes out to be 12. It'll take 12 years for you to double your money with 6% interest using compounding. Now, if they say 8%, then it'll be 72 divided by 8, which is 9 years. It'll take 9 years to double your money. And if they say 10%, then it's 72 divided by 10, which is 7.2 years to double your money. So now, how do you use it, right? It's really simple. All you have to do is, anytime you hear that number, a return number, right, just immediately ask, right, how fast does it double, right? Of course, if the rate of return is higher, then it's going to double in a shorter amount of time, correct? So that's what you do. You can also use it as a deal filtering tool, right? If the sponsor or syndicator or general partner is claiming to be 15% return, that means you'll double your capital in 5 years, correct? 4.8 years to be precise. So if that's the case, then you can ask the question, is this believable? Does that even make sense that my money is going to double in 5 years? What are they doing? Like, question that thing, right? So it gives you a new framework, like a mental model to just question things, question more things. Yeah, what assumptions have gone in doing so, doing this projection, right? Now, you can also apply it to real estate in a slightly different way, right? For example, rent growth projections. So if somebody says the rent grows at 5%, right, then it's going to take, that means rent will double in 14 years. Now, if they have a projection and in that projection they're showing it doubled in 10 years, then you can question that. That's pretty wrong, right? So you can also look at rent growth projections and then say that how much time it will take to double the rent, right? And same about appreciation, right? Look at the appreciation of your property, how much percentage it's appreciating every year. And based on that, you can see how much time it will take to double the property value, right? So it's just, again, it's just a very easy to. Now, you can also use it in a reverse way for inflation as well. So, for example, if the inflation is 6%, which is very high, by the way, okay, then in about 12 years, everything will cost double. Correct? And that's a problem. So similarly, you can figure out how much time it'll take for prices to double as well, or something to cost double the amount, right? So you could also judge, you can take the inflation rate and similarly use it to see when the prices will double. Now, it can also be used as a tool to understand how much will be the effect on you if you start investing late, right? So for example, you start at 30%, 30th, or when you start investing when you're 30 versus when you start investing you're 40, right? And you can simply calculate, like there'll be more doubling periods available to you for someone starting at 30 versus someone starting at 40, right? So you have to make sure you have more doubling periods left for you. You have to start investing as early as possible. So this rule also sort of wakes you up and tells you that you need to start investing early. Now, it is important to understand that these are estimates. It doesn't cause exact doubling periods around it. And especially it works really well between 5 to 12% return. So it doesn't work that well if it is below 5% or it's above 12%. So it's not a calculator. It's a gut check. It's a quick back of the envelope check for a deal. So if you do calculator and say, wow, it doesn't make sense, then that's the reason, okay? The number might be a little bit off, but it still gives you a quick check. This has been practiced for years and years in the financial industry, right? They just, rule of 72, they just check quickly investment, if it makes sense, then people go and use their calculator. Now there are other metrics also that used in financial industry, like rule of 114, which is for tripling, rule of 144, which is for quadrupling, right? And there's also rule of 70 for lower returns, lower than 5% returns, right? But again, I mean, most ranges are between 5 to 12%, so you'll be okay with the rule of 72. You don't have to remember all these other rules, right? There's a lot of interesting information like that related to investing on our website, oldmoneycapital.com. So I want you to please visit our website and then click on request a call button so that we can have a one-on-one chat on how we can help you achieving your investment goals, how we can help you in multifamily investing. So please go to our website, oldmoneycapital.com, and click on request a call button to schedule a no obligation session, right? It's just educational session. You don't have to, there's no harm in educating yourself, right? Our Instagram handle is oldmoneycapital123. And if you haven't subscribed to this YouTube channel yet, then please subscribe to this channel so that when we put out an interesting content or a video like this, you will get notified. Thank you very much for listening.